Hey, what's up everybody? Coming back to you with another video. We're going to be reviewing PayPal. We're going to do an analysis on it and a DCF model. But of course, before we do start the video, we have to acknowledge the fact that PayPal dropped like well over 20% recently after earnings. And then we have to ask ourselves, does that put it in fair territory for a buy? Or did people already think it was a buy with where it was at and now it's really a buy? I don't know. But I think we should go ahead and look at the numbers and see what they tell us about PayPal and if it's even worth your time after the plunge. First thing I like to start off with when reviewing a company is looking at their PE, or price to earnings ratio. In this case, the PE is sitting around about 30 right now. A lot of websites are going to tell you it's closer to like 36 or 37 right now, but based on updated metrics from their last earnings, it actually should be sitting more around a 30 right now. Now, a big thing we want to do when considering any company is to look at their 5-year growth. So if we look at the revenue in 2017, it grew from $13 billion to about $25.4 billion in 2021. So PayPal has definitely been growing their revenue. Next, we look at their net income, which in 2017 was $1.79 billion, and it's grown to a trailing 12 months of $4.93 billion. Yeah, sorry, not all of the websites have updated their metrics because PayPal just had their earnings report, but also PayPal didn't even mention it. I looked through pretty thoroughly, and unless I missed it, I didn't even see them put their net income. So now free cash flow in 2017 was $1.86 billion, and it grew to $5.4 billion in 2021. They definitely grew their free cash flow over the last 5 years. Another fairly important thing to look at is their debt. The first thing I like to look at is their 5-year average free cash flow. Multiply that sucker by 3, and then is that more than their long-term liabilities? So the 5-year average is roughly $4.08 billion, and we multiply that by 3, and it roughly came out to $12.2 billion. Now we need their long-term liabilities to be under $12.2 billion. PayPal's long-term liabilities is $9.7 billion, so we are in the clear for their debt. The other thing I like to look at, though, is current ratio, which is your current assets divided by current liabilities. Basically what that's saying is if PayPal liquidated, would they be able to have enough current assets to cover all of those current liabilities? Now the number needs to be over 1 because that means, of course, that all the current assets cover all the current liabilities, but I like to see the number closer to 2. PayPal's current ratio is 1.22. So not quite where I like to see it. It is over 1, meaning that all the current assets can cover the current liabilities, but it's still not in my comfort zone where I like to see it around a 2. Now for my DCF model of PayPal, I used the following numbers. I projected revenue growth of 13% over the next 5 years. I then use a perpetual growth rate of 2.5% thereafter. I always use 2.5% because that's the average inflation rate. That's the average rate at which the economy grows in the US and other major economies. And on most stocks, it still keeps you in a more undervalued range. You don't ever want to use some ridiculous number like 5%, because then you're basically saying, oh, this is one day. If it grows forever and ever perpetually at 5%, one day it's gonna like outgrow the entire US economy or just other economies or the entire stock market. That really doesn't make any sense. So I stick with 2.5%. We also need a weighted average cost of capital, or WACC, which in this case, I used Finbox to find it, and the in-between or average number they had was 6.5%, so we went with that. Now we do need a weighted average cost of capital because it is applied to the terminal value that you find for the company. You need that weighted average cost of capital to discount the numbers along the way. Now just a little recap. I chose 13% as the projected revenue over the next 5 years because Yahoo estimates said 16.8%, which sounded a little high, and I ran a CAGR, or compound annual growth rate, on the last 5 years of revenue, and it came out to 14.2%. So I thought I'd go a little lower than that and do 13%. However, I will acknowledge that I'm sure analysts are probably keeping in mind that the deal that PayPal now has with Amazon, where, well, Visa is kicked out and PayPal came in, is a major tailwind, but that's in the future, and I'm not going to make that part of my current estimates. We also had to choose a discount rate based on the return that I want each year. I go with 12% because on average, if you go with an index fund, you can get like anywhere from 8, 9, or 10%. And I want to beat that, or why am I putting the work in at all? Now look, after running all the numbers for my DCF model, the average fair value came to about $109 a share. Now I did use conservative metrics, as I always do, but still, even if I didn't use conservative metrics, it may have been still under what the current share price is, or right at it. But again, to give yourself some upside potential and keep you safe, you should always be conservative. Again, in this case, we projected revenue growth numbers over a 5-year period of 13%. I used a perpetual growth rate of 2.5%, and I factored in a 12% return for myself each year. And yeah, based on the DCF model, it is not a buy. $109. The last I saw, the stock price was around 132. This is after the 20+% plunge. This puts the company at roughly 22% overvalued. This should be a wake-up call to a lot of people that just because a stock plunges huge doesn't mean that it's a good deal yet. You have to be willing to run the numbers, do an analysis, and decide if it is a good deal. Based on the model, it's not. I'd also like to keep in mind that these are basically the same metrics that we had available to us before. And based on the numbers we had available to us, people were buying this at $200+ at one point, saying it was worth it, clearly just not paying attention to the numbers at all, not running a model themselves, or trusting in maybe some random site that ran their own model, but were very, very eccentric about the numbers. Like, to even get close to that $200 range where it was before, people must have been projecting like anywhere from 25 to 30% revenue growth over a 5-year average, which is just really not realistic. I don't know, maybe somehow it is realistic. Like, maybe the tailwind from the Amazon deal is so huge that that happens. But guess what? Don't make that part of your conservative estimates. Get into PayPal when it's actually at the correct buying level, and then let that be big upside potential if they do end up knocking it out of the park. Now again, the model says it is not a buy. Fair value, or intrinsic value, is $109 a share. It is currently at $132. Last I looked, and that was after the plunge that they just had after earnings. All right, so that's gonna wrap it up for this video. If you feel that this content added value to your day, give the video a thumbs up, subscribe to the channel, and if you have any thoughts on PayPal, comment below. Do you agree with the model, or do you think that it's probably within buying range at this point? Let me know down below. And with that, let's wrap it up. Y'all have a great day.